ramp. And that's when you'll see the bigger portion of the move in silver than what we saw from November through January. Seemed like a lot, but on a ratio basis, hardly even reflected the dimension of the prior range. So anyway, I think we're sitting on dynamite there, and I think it'll unfold largely by early to midsummer. The silver drop, we expected one. We frankly didn't expect it to occur in late January. We thought maybe it'd be late February or March. We had a major, what you call a green light go on that informed us through our studies that when the spread of silver breaks out versus gold, meaning when you plot the relative performance of silver on a chart relative to an ounce of gold, divide silver into gold, express it as a percent, there was a technical level to break through that would indicate, oh, silver's breaking out. Silver's going to launch versus gold. That was the November close. Okay, that occurred. When this has occurred before, over the past 50 years, what's happened in the following couple quarters is an explosion in the net price of silver. While gold still goes up, silver goes up a lot more. And it usually gets its job done in a couple quarters. Well, start from November, meaning December's month 1, okay, then month 2. So we kind of thought maybe you get into month 3 or so, there's usually a midpoint stumble. This one was sharper than we had expected, but it doesn't do any damage to our long-term momentum trends of gold or silver whatsoever. Yes, you did some short-term damage. And in fact, you said a couple days, you were right. That break was actually 1 day and a half. One day, the last day of January and into the first trading day of February, and then you made your low. Since then, silver has gelled, and we're now $20 off that low or so, or 18 or so off that low. And we're still well below the high. But gold, interestingly, though silver's still been outperforming gold even since November, went back up and had a close last week, I think it was, at 53.11 on the front month contract, which would be the April future right now. If you go back and look to January, not the high trade, admittedly that got up to 5,600, but the high close on a daily basis was 53.40. So effectively, we came back up to it, to the high on a closing basis daily, and basically matched it in gold. And then with that news of the war, which people thought, oh, you buy that. No, you don't. You don't buy war news in the monetary metals. Suckers come in and buy it, in which case they're vulnerable to get kicked in the shin. And sure enough, they did. If you bought gold in the rally early this week, it was up to 96, I think. They bagged them. Okay. Now we're trading 83, 84. Okay. But gold went back to its high effectively. Now that's not the way gold behaves if it's topping. Whenever gold has made a major top or a major bear low, 2011 high, 2015 low, it's isolated. You don't come back to that low or come back to that high. You may try to, but you never do. Gold went back up and basically matched on the daily close, the peak close of January. And then when you look at the miners, heck, they went back to their highs and even marginally nipped them out. That is, again, a sign that the air is not so thin up here that it's a top. In other words, you get up there and you fail, and then that's it. This time we go all the way back up to the highs again in the miners. Yeah, they pull back since, but you don't go up and make double tops. That's not the way the monetary metals have ever peaked or bottomed, with double tops. They go through it. It's setting up a triple top breakout. Now, silver's the laggard right now, but you got to look at the mama metal and the miners, and they're saying, hey, this is not as weak looking as you think it is. Anyway, that's our view right now, is that the metals are basing. We suspect by the end of this month, you'll see much more evidence of that. And by next month, probably new highs.
One of the most important signals in the precious metals market is the relationship between silver and gold. When analysts compare the value of silver relative to gold, they can identify shifts in market leadership. In November, a major technical breakout occurred in the ratio between silver and gold. Historically, similar breakouts have often been followed by periods where silver significantly outperforms gold. Over the past 50 years, whenever this pattern emerged, silver typically experienced explosive price gains within the following months. While gold also rises during these phases, silver tends to move much faster. This dynamic has made silver one of the most volatile but potentially rewarding assets within the precious metals sector.
Silver and silver miners. In other words, of the two metals, I'd buy silver. Okay. Of the two mining categories, gold miners or silver miners, I'd buy silver miners. This is a technical statement. Silver broke out versus gold on a relative performance basis, and despite the sharp pullback at the end of January, that spread did not break down. In other words, the relative performance breakout we had in November has not been negated, okay? And then when we look at silver miners and plot them in relation to gold miners on a relative performance basis, again, a spread chart, they've broken out. In fact, they broke out like a couple quarters ago. And sure enough, they've done better than the gold miners on a relative gain basis. And so those two factors echo each other. They're saying silver miners. So it's not just silver versus gold, it's their miners, which are vastly underpriced, if you look historically, to the gold miners. They're very cheap in relation to. And so is silver still very cheap in relation to gold. So I think both of them have a lot more to go, not just in net price, but in their relative valuation to gold.
Beyond the metals themselves, investors closely monitor mining companies for clues about market direction. Mining stocks often move ahead of the underlying metals, acting as a leading indicator for future price trends. Recently, companies involved in precious metal production have shown surprising strength. Many gold miners and silver miners have climbed back toward their previous highs despite the recent market volatility. This resilience suggests the sector may still be building momentum rather than approaching a major peak. Historically, strong performance in mining stocks often precedes larger moves in the underlying metals. When both the metals and the miners begin advancing together, it frequently signals the beginning of a powerful phase of the bull market.
The dollar decays, the quantity of dollars, M2, for example, basically increases 80 to 90% every 10 years. What a worthless piece of paper. I mean, I've said it probably on your show before, but your granddad built a house for $4,500, your father for $45,000, and now if you want a median priced home, it's $450,000. Is that because houses are going up in value? No, it's because the money unit's collapsing continually. And so when the Fed panics over issues like their government paper not being perceived to be stable, and they print to save their bonds, or they print to help the financial sector because they realize that's the one they got to really protect, even though it's not a mandate. They print money. They cut rates, then they print money, and it gives them an excuse to even push further on the pedal. And the Japanese are doing it. In fact, the new prime minister over there was elected, a year ago or so. She claimed to be sort of like a replica of Trump, intellectually speaking. And she used the phrase print, print, print. That's what she's going to do to defend those bonds. Well, I mean, that's like, that's hardly what you call a free market point of view. That means the money unit's going to be destroyed by the government just to protect their paper, okay, which doesn't ultimately work. But ultimately, it does do something. It drives up real money, gold and silver. If you think about this another way too, silver was capped for 50 years at $50, with lows down around $4 or $5. Okay, so dimensionality there of $45. If you take that dimension and add it to the high, which is 50, you come up with a swing target of 95. If you go back and you'll notice on the way up to 120, there was a fighting effort in mid-90s. Some people said, hey, we've reached the swing objective. And they tried to top it and it didn't work. It blew up to 120, okay? So meaning that didn't work. But if you take that ratio between the lows of that 50-year range and the high, that's a tenfold range in dimensionality. Tenfold times 50 is what, okay? You get the point. Also, if you factor in the decay of the money unit, M2, how much has it increased since 1980? You can do your own homework on this. Or since 2011, even when we were at $50 the second time. That would project silver like 250 to 500 just to get even with its real dollar value. And also when you look at things like copper and lead, they had a range like silver had for decades. Silver stayed in its range up till just recently. They broke out in 2006, 2005 for copper and 2007 for lead. And what did they do in the couple quarters after that? Quadrupled in price and then lived in a new reality. How come silver wasn't able to do that? Gold made new highs each time it made a bull move. Eightfold gain, constantly blowing out the prior high, but silver wasn't allowed to. Well, whoever tried to restrain that didn't succeed. Okay. And so there's still chatter about, oh, golly, they're manipulating the market. Yeah, they may be, but are they winning? No. Silver's not $35. It's not 50. They lost. And, they're going to be trampled if they try to get in the way, especially if you go back. If you push gold back up above that 5,300 again on a close, it won't stop this time. Silver will ramp. And that's when you'll see the bigger portion of the move in silver than what we saw from November through January. Seemed like a lot, but on a ratio basis, hardly even reflected the dimension of the prior range. So anyway, I think we're sitting on dynamite there, and I think it'll unfold largely by early to midsummer.
Another key driver behind rising precious metals prices is the long-term decline in purchasing power of paper currencies. Over decades, money supply growth has steadily increased, reducing the value of individual currency units. For example, measures such as M2 money supply have expanded dramatically across many economies. This expansion reflects central bank policies designed to stimulate growth or stabilize financial systems during crises. When governments increase the supply of money, tangible assets like gold and silver often benefit. Investors view these metals as long-standing stores of value that historically retain purchasing power during periods of inflation, currency depreciation, and financial instability.
Some of the biggies, yeah. I think J.P. Morgan and also another major bank, I'm not sure, it may have been Morgan Stanley, projected gold reaching a level we've mentioned a year or so ago. That's 8,000 plus. And the rationale for that, and I'll repeat it, I've probably said it on your show before, it is nothing but a replication of the two prior bull moves in gold. They were both eightfold dimension. Bear low, bull high. Bear low to bull high, 8 times gain from the low. Well, our low was what? 1,050. You do the math, okay? Now suddenly JP Morgan comes up with a number of 9,200 or something as a target based on some fundamental analysis they did. Fine, but it's interesting to hear that now. A year after we've been saying, hey, that's no big deal to even go 8,000. We've done it twice before, eightfold move. And consider the background that we're living in, the fundamentals that are underway. Government debt problems. That wasn't the issue in 2007 to 9. It was mortgages. Now we got government debt being questionable, okay? Long-term debt. Whoa. I mean, that's a major asset category. It's bigger than the stock market. It used to be an alternative to the stock market. If the stock market was in trouble, you could buy bonds. In fact, that worked. 2007 to 9, stock market imploded, bonds went up. So did gold during that time. 2000 to 2002, stock market got cut in half. NASDAQ dropped 80%. Gold went up during that time. Bonds went up during that time. Right now, bonds are suddenly, not so sure they're going up. Yields might, but the prices isn't. So what does that leave you with? One alternative. And it's never the case in history that when you have an asset class implosion like that everything goes down. Yeah, there might be a moment here or there where gold goes down with the stock market, but basically its trend will be opposite a stock market bear. And so if all of a sudden you don't even have T-bonds as an alternative, wow, you have a vacuum. And anybody who is continually calling for tops in gold and silver, it's a continual process. And every time they do, I'd have never seen a bull market top in gold where everybody screamed it was a top. Okay. In fact, in 2012, when we put out what we call the top in the gold market, we said it's over. We hit 1920 and we dropped into January of 2012 and we said that was it. It's over. Only 2 months off the high or so. Over the next year, gold went sideways, but never got back to the high. And we had complaining subscribers. We had to write a report called Open Letter to the Gold Bulls. Okay. Explaining to them, sorry, we know you love it. It's good in the long term, but it's going down. And we gave them the technical reason. Right now, we have zero technical long-term reasons to assume gold has made a top or silver. So it's a totally different situation, yet everybody's crying, it's over. I love it.
For decades, silver prices remained trapped within a broad trading range, rarely exceeding the symbolic $50 level. This long-term ceiling created the perception that silver was permanently capped. However, history shows that once commodities break out from multi-decade ranges, they often enter entirely new pricing environments. Other industrial metals, such as copper, experienced similar breakouts in the past and quickly multiplied in value afterward. Some analysts now believe silver could be entering a comparable phase. If long-term price ceilings are finally broken, the metal may begin establishing a dramatically higher valuation range than investors have seen in previous decades.
They've been saying it all the way up, not with silver, but with gold. Every time gold makes a high, a prominent high, it usually will plateau for quite a few months. Look, go back to April, May, June, July. It took like 5 months for it to get up out of that range it was at. And every time we do, everybody who calls for a correction thinks it's going to go back to the high end of the prior range. And if you go back and look, it doesn't do that. It hasn't done that. It's had drops, but it never goes back to the orthodox level where people say, that was old resistance, it's now support. So they're using a rationale that isn't working. And we have the same thing going on right now. Silver's going to go back to 50. That's the top. Well, anything could happen, I guess. But our work says no. It says you better be prepared, because if you don't break this market real soon, further than what we saw on the first trading day of February, basically you could circle it on all the miners, on gold, on silver, just circle that. And look where you are now compared to that. You better go take that low out soon, or you better think a different way. This is not a normal bull market. So the orthodoxies of, oh, it's overbought. Yeah, in a normal situation, yes, it is. But that doesn't mean this is a normal situation. And therefore, you can get overbought and stay overbought longer than you might think, in which case you missed the move. Okay, so anyway, that's our assessment right now. We think that we're not issuing any long-term buys, and the reason is we issued 3 over the last year or so. One was in April, May, June of 2025. Gold was coming up back toward 35 again. We issued one in early 24 when it was coming up through 25 to 26. That was a major buy for us. We knew it was going to blow out the 25 level, which it finally did, and it zoomed into the 30s. Then it congested for a whole year with tops at 35. We had a pullback into April last year. Started moving back up. When we started to move back toward those old dual highs at 35 plus, we said, this time it's different. It's going to blow through. It's going to accelerate. That was our second major buy. Our third and final major buy, based on long-term metrics, was the November close. That's when silver broke out versus gold. We're not going to offer any more buys. In other words, if you're buying now or later, you're on your own. Yes, you're probably going to make money, but it's not an optimal point of entry. And that's what we try to offer.
The broader financial landscape may also favor precious metals in the years ahead. Rising global debt levels, unstable bond markets, and economic uncertainty have led many investors to reconsider traditional safe haven assets. Institutions such as J.P. Morgan Chase have even projected significantly higher long-term price targets for gold, reflecting growing concerns about global monetary stability. Historically, gold and silver perform well during periods when traditional financial assets face pressure. If government debt challenges intensify or financial markets enter a prolonged adjustment, precious metals could become one of the primary beneficiaries of shifting investor confidence.